Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 23rd, 2022. Appreciate you all tuning into this channel as well as our podcast, InvestTalk. Now this week I'm going to title the video Market Start to Price in a Fed Pivot. And we're going to look at this a little bit deeper now. Let me bring up this as well. I actually have not looked at this, but I want to look at it kind of live in my reaction of where things have moved over the past couple of days. But what I want to start off with really is the Philly Fed Manufacturing Index, which that one came out, was that Friday, Thursday, over the last couple of days. And let's see, last update, 21st? Yeah, so Thursday. And this was a second month in a row, negative growth. And this is a pretty strong indicator of what's going on in the economy. You can see how negative it got during the COVID shutdowns and all that. But usually this is positive. You have a brief stint here, 2019, where I went negative, but 2 quarters in a row, or 2 months in a row of negative print. That's a pretty dire warning. And that was, I think, something the market really started to pay attention to, along with the initial unemployment claims that ticked up once again to a new high on the year. So, we're still at relatively low levels. We zoom out. It's coming off of a low base, but you can see that the trend in the labor market is certainly down. Now, you had some good leading economic indicators, building permits, housing starts, etc. And those came out. Here's the month-over-month figure, building permits down, but down a little bit, down much less than this negative 7% we saw in May. But you can see this is in a pretty consistent downtrend, really ever since March and especially December, as rates started to go up. Same with housing starts, that peaked in April, and you have your third month or second month in a row of negative print here. Once again, still not as bad as a negative 11.86 in the month of May, but June down 2%. So that's always interesting to see. We know the housing market's weakening, but how weak is it getting? And certainly the numbers were confirmed a housing market that's slowing dramatically, as well as the existing home sales down 5% month over month. We're talking about 1, 2, 3, 4, 5 months in a row where the existing home sales are down from the previous month. Now, saying all of that, now all of that picture looks dire, and I think that's what the Fed is going to start looking at, is that the economy is certainly slowing in a significant way. And that's going to probably worry a lot of people. But what I want to do is point you to this chart. And this is monthly GDP, U.S. monthly GDP. Now, when you see the headline numbers, oftentimes they're usually quoted as real GDP, right? Subtracting out inflation. Okay, so that is a good realistic picture of the economy, because that certainly should be adjusted for inflation. But what you have to understand about earnings, about the prices of stocks, is that it's not adjusted for inflation. It is nominal. And so nominal GDP matters most to actual underlying stocks, because that's what drives earnings. Earnings are not priced and adjusted for inflation. Understand that. And I think a lot of people don't really think about that. And so you can see here, the first quarter, we had a negative real GDP print. But we were at 24 trillion in GDP at the end of last year. And by the end of March, we were at 24.5. So 24.1 to 24.5. The economy grew, not in real terms, but in nominal terms. And remember, nominal is what actually prints earnings, prints cash flow. Okay, so understand that, and obviously this has ticked up a little bit more since then. Now let's look at the Fed rate probability. So it's now an 80% chance of a 75 basis point hike in July. That's next week, the 27th. So that's pretty much locked in. Then the next question is, where does it go from there? Okay, now you have, we're going to call it 225 to 250. And now the best chance is 275 to 300. So what it's saying is the Fed after doing 75 basis points last meeting, 75 basis points at this meeting. He's going to slow their pace to 50 basis points next meeting. And then in November, there's a 50-50 chance they go down basically to only 25 basis points. And by December, remember, these are odds. So there's a decent chance we get all the way to 325. But right now, what you see is that these odds keep coming down, and it gets less hawkish, right? So last 1 day ago, or let's call it a month ago, it was a 47% chance we're at 325 to 350 in the month of November. Now it's moved all the way to 43, and the 300 to 325 has moved up significantly from 21% just a week ago now to 42%. So that's where we've moved over the past week. Okay, so understand that. Same with here. Look at this. A 75 basis point hike in September was kind of priced in. Now it's down to 40% and up to 53% on only the 50 basis point hike. So what this is showing you is the market is pricing in less of a chance of a Fed hiking path that is as aggressive as it is now, and as aggressive as it is promising. So I just wanted to point that out. Very interesting there. And now let's dig into the charts, and you'll see kind of that manifest in the rates market. Remember Thursday, that was the Philly Fed Manufacturing Index going negative for the second consecutive month, and that's when you saw rates really reverse here from nearly 3.1. Now we close the week down around 2.78. So that's a pretty big move, about 25 basis points in the span of 2 days. So I really wanted to point that out. And that also reversed the dollar just a bit, but mainly the yen. If you look at the yen here, and this is probably the strongest indication of what's going to happen with Fed rate policy, because the Bank of Japan, they're not moving their rate. Right? They're stuck at 25 basis points. They're not raising it. They've shown in no indication they want to budge, despite the fact the yen is in somewhat of a free fall. So if the yen is actually getting strength, what that means is that there's convergence, more convergence of the Fed policy and the Bank of Japan policy. It's been widely different over the past year plus, and a lot of that has to do, that's why the yen is so weak, is that manifestation of that continued spread between what Bank of Japan is doing and what we are doing. But if that starts to go the other way, potentially, where maybe we start to pause, or maybe we eventually cut rates, the yen is just naturally going to get stronger, okay, against the dollar. So I'm watching that, and you had a nice, over the last couple of days, rally in the yen. I also want to talk about the, let's go SHY as well. So these are short-term rates. You can see this going up. That means your short-term rates going down. And another indication that the Fed is about to pivot, or the market's starting to price that possibility in to a greater extent. And look at the VIX. The VIX has now made a lower low. I talked about this, where this has made a series of lower highs, and now you made a lower low. More indication, lower volatility is good for equities, vol-adjusted funds, vol-targeting funds, they tend to add back positioning when volatility kind of calms down, and that's kind of what you're seeing recently, and that adds some consistent flow back into the market. So I wanted to point that out. And then look at IWM to the SPY. This is something I've been kind of eyeing, in this little consolidation, bullish consolidation move up and consolidation sideways below the 100-day, and we broke out this week and had a little retrace today on Friday, but nothing really to worry about. Really, what dragged the market down today was Snap. And they had bad earnings, bad view of what's happening in the ads market. Now, there's two ways to look at this. Snap is definitely not the bellwether in the digital marketing space. It's had trouble for a long time. It hasn't made a lot of money over the history. It's lost money at the history of its business. So it's not that well run. So the fact that they're struggling in this market is not a surprise. But that kind of fed into a lot of the tech names. ARK here down pretty decently today, but mainly fed into the other companies that are heavily reliant on advertising, which is Google. You have Meta that was down nicely. And what else? We can probably look at Netflix that had a bounce yesterday or recently on earnings that, they kind of built an expectation they would lose 2 million subscribers. It was only a loss of like 1.2 million or something like that, but still they continue to struggle. So I wouldn't take this as an indication that this rally is done. But certainly was a negative day for the markets overall. I want to dig into the USO. You had oil kind of chop sideways, but the real story this week was natural gas continued to just have that pullback and now is powering right to new highs. So very interesting move there. I continue to like the natural gas space over the oil space if you're looking at different equity positions. Gold, after kind of breaking down, got a bid on Thursday and today, and trying to show a bit of a bottom here. It is at major support and it needs to hold here. Otherwise, things are going to get real bad for the gold market. But, as long as the 10-year pulls back, and that's really what's driven gold down is just higher rates. The further this gets away from the 200-day moving average, the worse that is for gold. But if it starts coming back into the 200, gold's certainly going to get a bid, and you saw that today. And then you just look at GDX to the GDXJ, the junior miners to the GDX, that continued with some upside movement this week. And if we can get this to break out, that's just another indication that money is flowing into the riskier parts of the gold market, and that would be a net positive. So that's what we're seeing there. And then let's just switch over to the S&P. And we've had that bounce. We moved to the 2.5 retrace, got a pullback, and now we moved back above the 2.5. So we should get to this 382. I still think we're going to work our way up to this 41 to 42, call it 42.30 mark. I think it's clearly the zone that the market's trying to get into. Maybe we just hit the low end of that zone right at the 382. Maybe we get all the way to the 50%. That's certainly possible. Positioning has been very, very negative. So there's certainly that possibility that there's short covering rally. I talked about the vol targeting funds, adding back positioning, various aspects that are likely to bring some flows back into the market. Now, how long these the legs of this bear market rally have, we'll see. But so far, it's relatively short term. Bullish, and it remains a market that we're finding a lot of value, especially small caps versus large caps. Small caps are much better values out there than those larger cap names. So that's my take for this week. I appreciate you all tuning in, and a reminder that the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial and those associated. I thank you all for tuning in, and you have a wonderful weekend.